Okay, so all right. Hello everyone, wishing you all a very pleasant morning. And I am Moin for it Sheikh, and today I am going to present on the topic smart money moves. So this is a note disclaimer, and so let's kickstart our today's session on smart money moves, unveiling bonds, mutual funds, and valuation strategies. So earlier in the first session, we have discussed about bonds. What were bonds? What are types? And now we will be moving further to mutual funds. Okay, so let's get to our slide. Mutual funds. So let's dive deep into the world of mutual funds. Now, what are mutual funds? So as we all know, we all have discussed it earlier. So they are the people who pool money from retailers, from the investors, and then they invest that money into the financial market. So this is done by the experienced professional, also known as an asset manager, and they diversify our portfolio to avoid the risk, and whatever return they generate, they give some percentage they give us as a profit, and some they keep it for themselves. Okay, so yes, this is about the mutual funds. Now next slide, history and growth of mutual funds. So the concept of mutual fund was started in the 18th century, and now we can see that the current industry globally, if I talk about globally, it is about multi-trillion dollar. So it has grown every year. We can say every decade the mutual fund industry has evolved, and it has been to multi-trillion dollar industry, which is a very very big amount. So here is the stats for the Indian mutual fund industry, the mutual fund industry in India. So it is a stat says that in the year 2024, the the as per the global market report, the the market size was $61.98 billion, and in the year 2025, which has just began, and we are half the way for 2026. So we can see that it is $745.82 billion, and every year we are having a growth rate of 10.6%. So the expected market size in the year 2029 is dollar hundred one hundred 1,116.72 billion, which is almost double since 2024. So yes, this industry is growing and developing, and and I don't think that it will decrease, or it will have a correction or a decline in the stage. So yes, it is a very good opportunity for us to invest in the mutual funds, because the market is we can see growing and growing, and the annual growth rate is 10.6%, which is much higher than the bank returns, and it also helps us to beat the inflation rate also. So yes, this is very much important. Now moving further, so I'll tell you how mutual fund works. How do they make money? How do they give us the income, the interest, the profits? Okay, so basically this is a mutual fund agency. There is a fund manager, and this fund manager pulls their money from investor. So this the above three are the retailers, These are we who invest our money, who gives our money to them. So this fund manager pools or takes the money from investor, and he has expertise in stock market. He has expertise in financial market. So as per his expertise, as per his knowledge and the experience, he invests our money into some securities. Okay. So he invests our money into some securities, and from that security he generates some returns. Okay. So from that returns, part of amount is passed to the investor as profits, and the amount and the remaining amount is kept with him or with the company. Okay. So this is how a mutual fund works. The chances of making losses is usually very low because he is an expert in that field, and he don't invest in any riskier asset. He only choose assets wherein the amount, the capital is safe, and wherein he can fetch more returns as compared to other stocks or other securities. Okay. Now, types of mutual fund. So these are the types of mutual fund. It is divided in classified into structure, asset class, and investment objective. So if I talk about structure, there are three types of structure mutual fund. One is close, second open-ended, third interval. So we will be studying about this in the further slides. Okay. And second, by asset class. So we have equity fund, we have debt fund, we have hybrid funds, we have money market funds. So this all we are going to study, learn about it in the further slides, upcoming slides. Just it is an overview of it. So by investment objective, diversified funds, income funds, liquid funds, ELSS funds. ELSS is for tax saving. For it has to save a tax, but definitely it is, as it is tax saving. It has some lock-in period, and usually they have a lock-in period of around 3 to 5 years. Okay, all right. So let's move further. Open-ended versus closed-ended fund. As we have studied that mutual fund is classified into three asset types, into three types: structure, asset, and investment objective. So if I talk about structure, we have studied three: open-ended, closed-ended, and interval. So what is open-ended? Open-ended mutual fund is nothing but wherein an investor can buy or sell anytime. Okay, so the name itself suggests that open-ended. It is open to all. Anyone can buy or anyone can sell it anytime, anywhere, and any point of their convenience. Okay, so here NAV fluctuates daily. Now, what is this NAV? NAV stands for net asset value, where we are going to study it in the further slides. But for now, keep this in mind that open-ended fund is nothing but a fund, but where a fund wherein the investor can buy or sell that fund anytime and anywhere if they want. Okay. Second, close-ended. So as we have studied open-ended, we can just get to know that it is a vice versa of open-ended. Basically, the close-ended, there are fixed number of units. Okay, the units for mutual funds are fixed. That is we cannot fluctuate. If let's say that a particular mutual fund has a 30 units, we cannot say that we want 20, we want 15, we want 35. We want to get only 30 or multiples of 30. For example, 30, 60, 90. Okay, and these are the funds that are traded in the on the exchanges like NSE, BSE, and all, etc. Okay. Now we have also seen at the interval fund. Now, what is interval mutual fund? It is a type of investment fund that allows investor to buy and sell units at predetermined interval. Okay. So it helps to buy and sell units at our predetermined intervals. So if I want to say for example I want to sell my mutual fund at a period at after every 3 years, or let's keep it short, after every three months I want to sell my mutual fund and buy a new. Okay, so this is what, this is nothing but a determined intervals. Okay, now coming to the advantages of mutual funds, the very first point is professional management. As we all know that the the person which is investing our money is a professional, is an expert in his field. He has a very deep knowledge and understanding about the financial market and stock market as well. So yes, definitely this helps us to it saves our time and we don't have to do anything. We just have to sit and relax and enjoy our profits. So this reduces our burden. Second one is diversification lowers risk. As I told you earlier that if you keep all your eggs in one basket and if it falls, then you are going to lose all of your money, basically all of your eggs. So this is same with our money as well. So we have to diversify our portfolio. For example, we have to invest some amount in a particular stock, some in another, some in bonds, some in mutual funds. So this is what we are diversifying our portfolio and we are reducing our risk. Okay. Liquidity. So yes, mutual funds are easy to buy and sell. Even you can start an SIP of rupees 100 per month and it can go up to rupees 10,000 or 50,000 or anything which we want. Okay. And yes, so it is very liquid. We can easily buy and sell the units. Affordability, as I told you that we can start with 100 rupees SIP. We can invest rupees 100 in mutual fund every month. Or yes, so it is very much affordable, basically. So here is an example, you can consider it. An investor with rupees 10,000 can diversify across 50 plus stocks. Okay, so if you will say that my I have a capital of rupees 10,000, how can I invest in 10 stocks or more than 10 stocks? So yes, through mutual fund it is possible. Even you can invest in Nifty 50, Nifty Bs. So these are the fund that diversify your capital into different stocks. They have a group of 50 companies, 40 companies, 30 companies. So if you invest in that fund, automatically your capital is divided into this 50 to 30 companies. Okay. So now we have studied the advantages of mutual fund. Now we'll see disadvantages of mutual fund. Management fees reduce returns. So as I told you that there is an expert, there is a professional who is managing our fund. Definitely he will charge some fees. So that fees are not charged directly by him. The It is charged by from the company which he is working. The professional, the expert who is working in the company charges us with some fees. For example, if I say there is some sort of brokerage example, a very few basic example brokerage, and yes, there are lot many charges that we have to pay that we will see in further slides. So yes, so if we are earning rupees 1,000 for example, so there are some charges, brokerage, tax and all. So after deducting that, we get very less, we can say a less money amount of money from them. But yes, definitely it is much more than the inflation rate. So yeah, it is good to invest in mutual fund. It is not like we should not because there is a high management fees and all, etc. Second, lack of control. Okay, so we don't have control over our, our capital, because we have given to some person and he has a authority, he has a control to, to buy or sell. We cannot say that now, yes, you should buy now because the market is volatile, because the market is fluctuating, or you can sell it. It is only possible if we break our mutual fund. If we want to, withdraw our mutual fund, at that time only it is possible that we just have to tell them, "Okay, I just want to withdraw my earnings and all." So they'll give you all. Okay. So we cannot say that, okay, so this stock will rise, so invest in that stock and all, etc. etc. All right. Third point, potential for over diversification, diluting gains. Potential for okay. So yes, it has a potential for, over diversifying the stocks. If there is a stock of rupees 100 and there are similar 10 stocks with it, so now you will think that how my 500 rupees will go into this stock. So this can be only done with in the mutual fund, wherein we can over diversify and dilute our gains. Okay, we'll get a some percentage of it. Then the last point, market risk remains. Absolutely, we know that there is the risk in the financial market. The market risk is constant in every securities. So even we have seen in the ads, like they say that mutual funds are subject to market risk. So market risk is one such factor that can affect your gains. Okay. So if the market is going well, if the industry is performing well, you will gain, and if it not, you will face losses. Okay. So here's an example of management fees. I told you there are a lot of. So one is high expense ratio. So high expense ratio funds may underperform after fees. So if the expense ratio is high, that particular firm can underperform. Okay, because of its high expense ratio, no one is going to buy that fund. So basically, that fund is what it is underperforming. That is, it is low volatile. That is, the volume traded is much lower. Okay. So now coming to the next slide, how mutual funds makes money. At the very first, capital appreciation. Now, what is this capital appreciation? It is nothing but an increase or rise in the price of an asset, of a particular security. If that security, if the price of that security increases, then automatically they make money, and a part of it is given to us as a profit, as a earning. Okay. Second, dividend and interest earned by the fund. Okay. So what all dividends and funds are earned by the fund, they they help them to make money. Okay. Reinvestment grows NAV. Now what is this reinvestment? So if I have invested my 10,000 rupees into in a mutual fund, and every year I am getting a return of, say, let's say around 10%. I have invested rupees 1 lakh and I am getting around 1,000 or 10,000 rupees, 10,000 rupees per month, sorry, per year. So that 10,000 interest I'll not withdraw. I'll just reinvest that into my actual mutual fund. Okay, are you getting me? So that will help me to to grow my NAV. So my capital has increased from 1 lakh to 1 lakh 10,000, and the same goes for year on year. I'm not removing my any earnings or gains or dividends or interest. I'm just reinvesting into it. Okay. For example, you can consider this example. Fund holds IT stocks rising in value, plus dividends generate return. There is a fund who holds IT stocks that is rising in value. Also, the dividend which they get, they reinvest that dividend into that stocks to generate more and more returns. All right. So let's move forward. What is NAV? The most important concept in mutual fund, NAV. NAV stands for net asset value. What is this? This is a price per unit of mutual fund. Okay. This is a price which you are going to pay on a unit of a mutual fund. Okay, all right. This is very easy. If I talk about in simple terms now, the the price which you are paying for a unit is nothing but your NAV, is your net asset value. All right. So calculated daily, yes, the NAV is calculated on the daily basis, and the formula is market value of assets minus liabilities divided by number of units. We will get NAV. For example, if fund holds rupees 10 CR assets, if a fund has a 10 crore asset with them and the units are 1 crore, so the NAV will be rupees 10. Okay, that means we have to pay rupees 10 per unit of it. If I want to say, if I want to buy 100 units, I want to pay rupees 10 per unit, that is equal to 1000 rupees. Okay, followed? Are you getting my point? If I want to buy 1 lakh units, but the NAV is rupees 10, so I have to invest 10 lakh rupees. 1 lakh into 10, we get 10 lakh. Okay, all right. So let's move ahead. This was all about NAV. Types of equity mutual funds. Okay, this is very important. This thing we should know, that the types of equity. Oh, sorry, the types of equity mutual funds. So first we have large cap mutual fund. Second, mid cap mutual fund. Third, multi cap. Then sectoral or thematic funds, dividend yield funds. Okay, so dividend yield funds, the name itself says dividend yield. Yield is what which we are getting in return, the amount that we get in return. Okay, so dividend yield funds. So these are the funds that are more specific, more tilted towards the company that gives dividend. They earn through the majority of their earning is through the dividend. Okay, so yes. Then seventh one is value funds, and eighth point is growth funds. Okay. So now what are these mutual funds? The number one, large cap fund. What is this? So these are the fund that invest primarily in stocks of of large capitalization of a company who has a large cap. They basically they invest in the large cap companies. Typically, they are among top 100 companies in terms of market capitalization or etc. So, what are these large cap companies? These are the companies that are well established. Okay, they are financially stable, and and they are the industry leaders. They are the leading. Their products are leading in the industry with a history of consistent returns. Okay, they have a long history of consistent returns, consistent profit. So these are the large cap companies, and the mid cap companies, they they are not that well established as compared to large cap, but yes, they are in the growth stage. Okay, so the risk is at a medium. There is a medium level of risk. If I talk about large cap companies, the risk is very less because they are well established, they are financially stable, they will not go under losses. So the risk is very low. Whereas in the mid cap, the risk is we can say medium. There's a medium risk. Okay. And if I talk about small cap companies, the risk is much higher because we don't know anything anytime the company can collapse and we can get losses. Okay. Fourth one is multi-cap funds. Now, what are these multi-cap funds? Multi-cap fund is nothing but, a fund wherein our capital goes into different, different cap. Basically, multi-cap. Okay. This is a fund that includes large cap, mid cap, and small cap as well. So that's why it is named as multi-cap fund. All right. So we have seen dividend yield fund. Now, yes, the very important sectoral or thematic fund. So what is sectoral fund? So we will just break this into two. Sectoral, sector. Sectoral words come from sector. So it is a sector fund. That is, it is specially, it is mainly into a particular sector. That this fund, sectoral or thematic fund, is about a particular sector. For example, sector of, if I say, IT sector, banking sector, healthcare sector, or energy sector. So these are the fund that focus on only one of this sector. Okay, got it. Then second is growth. The last one is growth funds. So these are the fund that grows our money. Like if you want high growth, that so we can invest in it, but it is very risky because these are the funds that invest our money that they feel that they are going to grow in the market. There are some companies which they have, and they are thinking like, yes, these are the companies that will grow in the market in the future. So this is a bit risky. Okay. Now last is value funds. What is value fund? So it is a type of equity fund, that invest in stocks of companies that are believed to be undervalued. So as we all know that if a stock is undervalued, we should buy them because in the future the price will rise. Absolutely. So these are the value funds that invest in the stocks that are undervalued. Okay. And we all know that we should avoid the overvalued stocks. So because you know what? Because the intrinsic value, because the value of a stock is rupees 100 and it is trading at rupees 120. So why we should buy in the much higher price? Instead, we should avoid that stocks and we should look for undervalued stocks. For example, if we have a stock that is that's if we have a stock which is priced at rupees 80, but it is trading at rupees 60. That means 20 rupees less it is trading. So we have to go with that stock. We have to invest in that stock because absolutely the prices are going to rise. Okay. So this was the types of equity mutual funds. Now we will move further. Now what is debt mutual fund? Debt mutual fund. We all know about debt. What is debt? Debt is nothing but a loan. Now what does the loan mutual fund stands for? What does it mean? So debt mutual fund is nothing but a mutual fund that invests in the fixed income securities, fixed income instruments. Do you remember the word fixed income securities? We have studied it in our first session. Okay. So these are the fund that invest their, money, our money into fixed income instrument like bonds, government securities, etc. So these are the fund that aims to provide a steady income to the people, to the investor. Lower risk and return than equity fund. Okay, as I told you about bonds, that we have a fixed rate of return and maturity. So you can see that the risk is also lower. And yes, we have some market risk and inflation rate risk and interest risk. But yes, it is lower than the as compared to equity fund. Okay. So here's an example: a debt fund investing in 10-year government bonds. So we have a government bond that is for 10 years, and a debt fund that is investing in that bond. So yes, definitely it will fetch us consistent returns, and the risk is also lower because it is government bond. Okay, all right. So let's move forward to our next slide. Hybrid funds. So what are these hybrid fund? The name itself says hybrid. Hybrid is nothing but a mixture of equity and debt. Okay, if we want more returns, but also we want less risk. So what I will do, I will invest in hybrid funds because it will balance my risk and return. Okay, for example, balance hybrid fund with 60% equity and 40% debt. So this is the hybrid fund. If I invest my 10,000 rupees, my 6,000 will go into equity fund and my 4,000 will go into debt fund because it is hybrid. So even if I suffer some loss in equity, I am making some profit in debt. So that will balance my, balance my earnings, balance my portfolio. Okay. All right. Next. Next is a money market fund. Money market fund are basically short term in nature. They are basically they are the instrument, they are the fund which are invested for say less than a year because they are short term. And if I talk about long term, what does short term means? Anything which is less than a year. And what does the long term means? Anything which is more than a year. Okay, a year or above it. So it has low risk, suitable for parking money temporarily. If I want to, park my money, if I want to, invest my money into, and I want to keep it safe also. I don't want any risk and all. I cannot keep that money into my house because the reason you all know. So I cannot keep all the money into my house, and because we have certain risk. So what I will do, I will keep my money into money market funds, keep my capital into money market fund for keeping it for a short period of time. What are those? Treasury bills, commercial paper, cash deposits, etc., etc. Okay, great. Now we will come to SIP, systematic investment plan. So in today's generation, we all know about what is SIP. The SIP has grown a lot as compared to the past years. Okay. So what is SIP? It is nothing but investing a fixed amount at a fixed period of time, and it is basically on monthly basis, quarterly basis, or even there are some which are yearly basis. Okay. SIP is nothing but we are investing some amount, some fixed amount regularly. Okay, over a certain period of time. What are its benefits? Rupee cost averaging, discipline. Okay, so basically our money is compounded. Our money is compounded in mutual fund. So yes, it helps us to earn more. For example, investing rupees 5,000 monthly in an equity fund. So there are equity fund which offers us a higher returns at a higher risk. So yes, if you are ready to take the return and the risk, you should go with the equity fund. It will fetch you more returns, but yes, it has the same amount of risk with them. Okay, so moving forward, now we have a concept of systematic withdrawal plan. There we studied systematic investment plan, investment that what we are investing. Now here it is systematic withdrawal plan, how much we are withdrawing. Okay, systematic withdrawal plan to withdraw money, a certain money. Okay, so what this mean? SWP means we are systematically withdrawing a fixed amount regularly. Okay, let's say if I have invested uh, 10,000 rupees every month for 20 years. Now I want to start SWP. So I can switch to SWP and I can start, getting 30,000 every month. So this is nothing but a systematic withdrawal plan. So it is very useful during retirement. Why it is useful during retirement? Because I'll tell you. It is because, for example, I am working. For example, I am a working professional, and every month, I am investing rupees 10,000 into mutual fund. Basically, I am doing SIP of rupees 10,000. Okay, so I have done my SIP for 20 years. For 20 years, I have invested rupees 10,000. And after 20 years, when it comes to my retirement, I will switch to SWP. So after I retire, I'll get every month a sum of rupees, more than 20,000 into my bank account every month. So this is nothing but a systematic withdrawal plan. So this keeps our principal invested while generating income. Yes, our principal are invested while we are generating income. And it is tax efficient withdrawals. Okay, we do have tax efficient withdrawals, but some are very uh, tax effective and some are not. So we should consider that before doing SWP. Moving ahead, systematic transfer plan. Most of you might not be aware of this term. What is it? But you know what is it? It is a systematic transfer plan. That means we can shift our from one scheme to another. Okay. For example, if I am an investor and I have opted for one scheme of their one scheme, and if I'm not satisfied with if their particular scheme, I can switch to another scheme. But the thing is that should be of same fund. That should not be of any other mutual fund. For example, we cannot shift between IT to uh, healthcare or finance or banking, etc. Okay, so it also helps us to to minimize, to reduce the damages, and to avoid the market fluctuations. Okay, so this is nothing but a systematic transfer plan. Now we come to lump sum versus SIP. SIP is nothing but what we are investing a fixed amount of money at a fixed date. Okay, what we invest, and lump sum is nothing but we are investing a some lump sum amount of money at a one period of time, at a one particular point of time. If I say I have rupees 12,000 and that 12,000 I am investing in mutual fund, this is a lump sum I am investing. And what is SIP? If I am investing rupees 100 per month every year, so this is nothing but an SIP. Okay. So the benefit is in lump sum that we can invest large amount at once. Okay. So there is no need to, you know, if we have a certain amount with us, certain large amount with us, we cannot do SIP with that, na. So we every time uh, we have to distribute our part of money into SIP. So what we can do is we can directly invest it into lump sum, by lump sum. Okay. Here is an example. SIP protects against market volatility by averaging purchase price. So yes, SIP protects our returns, our capital against market volatility. because it averages the purchase price, the price which is available for the investor. It averages that price. Okay, so that's the reason most people prefer SIP, and also you get more gain, you get more returns in SIP as compared to lump sum. Okay, let's move forward. Mutual fund expenses. Okay, so as I told you that there are some, some expenses, some sort of management fees that are required by, that are taken by, companies. So what are these? The number one is expense ratio. Now what is this expense ratio? This is nothing but an annual fees that is charged by an institution to their investors, to their clients. Second one is exit load. So if we are, if I have chosen a mutual fund, and if I am doing an SIP with them, so if I withdraw that SIP early, for let's say for within a year I withdraw that, so I have to pay a certain fees. That is nothing but an exit load. The exit load is nothing but a load which is when we are withdrawing the mutual fund early. Okay, so we can consider one example over here. Expense ratio of 1% means rupees 10 on 1000 invested annually. Okay, so it is a very, it fetch, it reduces our returns, it reduces our earnings. So these are the expenses that reduces our earning. So that's the reason we should all consider this before investing into any mutual fund. We should always check their expense ratio, check their exit load, their brokerage, or anything that is there. We cannot just blindly put our money into a mutual fund by just seeing its growth, like it's growing, it is giving a good return. So we cannot directly invest in that money. There are certain parameters which we have to check. For example, we have to check about the fund manager. Who is the fund manager? How much experience does he have? How much knowledge does he hold? And what are the risk parameters? How he manage risk? Where do he invest our money? So there are a lot of parameters which we have to consider before investing, because because it is our hard-earned money, we cannot put it anywhere and we cannot give it to anyone. Okay, what if they make loss? We cannot do anything. We have just, lose our all our hard-earned money. Okay. So you should consider all these parameters, and after considering this, you should go for the investment purpose. All right. So mutual fund taxation. So you all must be aware of, long-term capital gain and short-term capital gain. The capital gain taxes which we pay to the government. So in the case of mutual fund, if we are, if we are withdrawing our earnings before a year, within a year, I should say within a year. So for that, we have to pay some short-term taxes. So from from my as per my knowledge and understanding, I think that current short-term tax is around 12.5%. Okay. So if you are exiting, if you are withdrawing your mutual fund within a year, you have to pay short-term capital gain taxes. Okay. And not if you are withdrawing after 3 years, after 2 years, and you have to pay a long-term capital gain tax. Okay. So as per the new tax policy, we have an exempt of over rupees 1,25,000. Okay, so there's a tax exemption. If our return does not crosses 1,25,000, there is no need to pay taxes. But if our returns, if our gains, if our earnings are crossing, are over and above rupees 1,25,000, then we have to pay taxes. Okay. For example, long-term capital gain tax over rupees 1 lakh on equity fund, tax at 10%. Okay. So this is as per the old income tax policy. The new income tax policy is we have an exempt of over rupees 1,25,000. If the amount goes up, so we have to pay certain taxes on it. Okay, are you getting me? So, so far as we have reached, do you guys have any query? Have any doubt? You can ask me. You can unmute yourself or you can type in chat box. Uh, any doubt if you have regarding mutual fund, you can ask me. Feel free to, ask me. All right, so we will move further. Now, how to choose a mutual fund? As I told you that you should check some parameters. Okay. Also, on the other hand, you should not consider your investment goals. Like, what are your investment goals? What is your risk appetite? How much risk you can bear? How much profit you want? You should have a clear vision of it. You cannot just simply invest and you will say that whatever returns you make, whatever profits you make, I want that. There should be a fixed percentage of profit that you should set in your mind. For example, if I'm investing rupees 1 lakh, I have a mindset that yes, I want to get 50% profit. And if I talk about risk, I can bear minimum up to rupees 10,000 rupees. I can bear 10% risk. So what is my risk to return ratio? It is 1 is to 5. That is, if I lose 1 rupee, I'm ready to lose 1 rupees, but I'm also ready to make 5 rupees. Okay. Also, we have to check the, you know, past performance from the past few years, how that fund is performing. Is it performing well? Is it in a low phase? We have to also check the fund manager record. I told you that how much experience does he hold? How long does he is managing that asset? Okay, so these are the parameters we have to check, we have to keep in mind before investing. So we can consider, for example, for long-term growth, choose equity fund with a consistent 10 plus years performance. Okay, so basically, if a fund manager has an experience of more than 10 years or 7 years, that means he's considered as an expert. So it is a bit safe for us to hand over the money to him, our money to him. Okay, so this is how to choose a mutual fund. Now, let's move ahead. Reading mutual fund fact sheet. What are these fact sheet? The fact sheet which we have, it is written in that is asset under management, portfolio holding, portfolio performance, about the fund manager, everything is written in the fact sheet. So we should always read that fact sheet so that we should have a clear understanding and idea about, yeah, like, yes, this is a mutual fund which we are going to invest. Okay, so let's consider an example. A rupees 500 crore AUM fund with majority of large cap stocks. Okay, so we will come to know that yes, the asset under management in this mutual fund is rupees 500 CR, and majority of those are large cap stock. That means it is a safe for us to invest because of the majority of large cap stock, there are large cap companies which are safe, which are financially stable, so we can go with that. So we have to read all this thing in the fact sheet, and also at the same point of time, we should have a good knowledge of it, because if we don't have any knowledge of what is AUM, what is portfolio holdings, what are large cap stock, small cap stock, then we cannot make a decision. If we know all these things, then only we can make a certain decision. Okay, are you getting me? Let's move ahead. Mutual fund versus ETFs. So ETFs trade like stocks. I have told you earlier in my first session. So we will uh, not waste so much time on discussing ETFs. But yes, ETF stands for electronic um sorry, exchange traded fund. ETF stands for exchange traded fund, not electronic. Exchange traded fund. And so the very a common difference that distinguish the ETF with mutual fund is mutual fund can be bought and sold throughout the trading day. Okay, we can bought it anytime, we can sell it anytime. But mutual funds are priced once a daily. So so they are just priced once. So if they are priced, we have to buy that. All right. But in the case of ETF, it is more of like stocks. We can buy and sell it anytime. But in the mutual fund, if we buy and if we sell on the same day, we have to pay some short-term capital gain tax, expense ratio, exit load, everything we have to consider. Okay. So ETF is very much liquid. We can trade it anytime, anywhere, and at any point of time. Whereas mutual fund has some, discipline, has some, requirements which we have to fulfill, which we have to meet. Okay, in order to avoid losses, and you cannot just buy a mutual fund and just sell it because you think that it is not going to perform well. Because if you buy and sell in within a less than a year, you have to pay some expense ratio, exit load expenses, then short-term capital gain taxes. All the things these are there. We should consider. We should keep it in your mind. Risk in mutual fund. So as we all are aware about market risk, we cannot predict the market. It is volatile. It depends upon certain factors. It depends upon government, natural calamities, or any sudden change in economy, budget. So these are the factors that affect the market risk. Second one is interest rate risk. So yes, for debt fund, as I told you, that the interest rate is a risk for an investor because we don't know that if there is a change in the interest rate by RBI, that for that bond or that instrument has to suffer. Okay. So third one is manager risk, poor management decision. If a company does not have a good management, a good corporate governance, and a good manager, so the decision will not be proper, and which will lead to the loss of our capital. So we have an example over here. Tech heavy fund falls during sector downturn. Okay, so when there is sector downturn, when it is bouncing back, when it is in the phase of downwards, the tech heavy funds falls basically. So these are the risks in mutual fund that we should look after it, and we should try to minimize our risks as much as possible. So how can we minimize? We can go for the large cap company stock or hybrid stocks, or so that our money is safe and we know that yes, we will get not much return, but at least we can expect some return from that stocks. And yes, so let's move ahead. Mutual fund redemption process. So as we all know, open-ended funds are redeemed at NAV on request. Okay, if you want to redeem our mutual fund, if I don't like my mutual fund and I want to redeem it at the new rate, so we can also do that in the on the request on a particular request. But it is only possible in the open-ended fund. In the closed-ended, it is not possible. Once you have chosen, you have chosen. You have taken, you have taken. Okay. So here you can see an example. Selling mutual fund units after 1 year to book gains. So in the open-ended fund, I can buy or sell my unit at any point of time, whenever I want. Whenever I can redeem my NAV. Okay. So it is a very good quality, a good feature of open-ended fund. Now we have all discussed about the mutual funds. Now let's move further and explore more about them. Okay. A role of a fund manager. Now what is the role of a fund manager? This is nothing but uh, but they have to make buy or sell decision based on their research. They have to do a proper thorough research about a company, about a organization, about its governance, about there is a lot of parameters which we have to consider for research. And after that, if it gives a buy signal, they have to buy or they have to sell. So yes, these are the decisions which are very crucial for them, because they have a large amount of money with them, and they don't want to lose because the investor will catch them. Okay. Manage portfolio to achieve fund objectives. So they have to manage huge portfolios of around hundreds of crores, thousands of crores portfolio they have to manage. So yes, they have a lot. They have a lot more stress, because a small mistake can lose a lot of money, lot of investors' hard-earned money. So they have to be very careful with that. So, for example, a manager reducing exposure to cyclical stocks before recession. So, as we all know, that manager should consider the recession. Like if there is a possibility of recession, the manager should should reduce the exposure to cyclical stocks that are more likely to affect the recession. Okay, he should consider the stocks that are recession friendly. That what does that mean? That, for example, stocks in spite of recession, the company, the stock is moving upward, because the role of the particular stock of a company is much more important to the people. Okay. So as far as now, anyone have any doubt, they can ask me. I am keeping 5 minutes for a question and answer session. So after this, we can take a break. So if you guys have any query, any doubt, any concern regarding mutual fund, please ask me. You can unmute yourself, you can raise your hand, you can type in the chat box, anything. Okay, so next 5 minutes we will be discussing any queries, any questions which you have. Yes, I have one message in the chat box. Let's see. Okay, Jasmina Sheikh, can you short brief about mutual fund benefits and disadvantage? Okay, all right. Why not? Sure. So, as I have told you before, the benefits of mutual fund are, we can diversify our portfolio, we can reduce our risk, and the dividend and interest which we get, we can reinvest it, and we can generate more returns. Okay, and the one more benefit is the the power of compounding. Our money is compounded annually. Okay, so if you are investing all your earnings, for say example, if you have invested rupees 10,000 rupees and you are getting dividend of rupees 1,000, so if you invest that also in your actual capital, so it will help you to fetch more returns. Okay, so yes, we have benefits are advanced portfolio, diversification of risk, diversified portfolio, and dividend reinvestment. So yes, there are many more lot advantages of mutual fund. But if I talk about, its disadvantages, so as I told you that there are certain expenses that you have to incur if you are, withdrawing your mutual fund, if you are selling your mutual fund. So the number one, exit load. Second, short-term capital gain taxes. Then third, expense ratio. So these are the expenses that you have to consider before, selling your mutual fund. So, if you are selling your mutual fund within a year, if you have bought and you are selling within a year, you have to incur a capital gain taxes, exit load, expense ratio, brokerage, and all, etc. etc. So, yes, it is very crucial to consider your investment very carefully. You have to consider your mutual fund and you have to check certain parameters. And yes, so these are the advantages here, like the ratio, the expenses are very high, the exit load, expense ratio, as short-term capital gain taxes, and even some has sales charges. And yes, so these are the some benefits and disadvantages of mutual fund. I hope you have understood it. Is there anything more I could put on your table if you want? Okay, about SIP. So as I told you, SIP stands for Systematic Investment Plan. It is nothing but, investing a fixed amount of money at a fixed period of time. For example, I'll tell you, like, I want to invest rupees 500 every month in a particular mutual fund. So this is what? This is nothing but an SIP. I am doing an SIP with a mutual fund. I am investing rupees 500 every month for up to certain years. Let's say I am investing for 2 years, for 3 years. So every month I am investing rupees 500 rupees in that mutual fund. This is nothing but an SIP. SIP is nothing but a systematic investment plan, wherein we are systematically investing our money, a fixed amount of money into a mutual fund. Okay, at a fixed date. Okay, are you getting me? Okay. So very good advantage of SIP is that anyone can start, even a working professional or even a student can start. So we can start an SIP only by rupees 100. So we all do get pocket monies, and so we all can consider an SIP for our investment purpose, because Warren Buffett, the greatest of all investor, he has told that, he started his SIP when he was at the age of 12. And those, in spite of starting at the age of 12, he said that I was late. You should start early. So at the age of 12 also we are late to start our SIP. So now everything is now, you know what, now is the best time to start an SIP for everyone to get maximum return, to generate more profit, because we can because in because they we have a very, you know, flexible SIPs. Like we can, it can go from rupees 100 to rupees 1000, rupees 10,000, anything, anywhere, anytime we can invest that amount into the mutual funds, into the schemes. So yes, so we should start as early as possible, because it will help us to get a good return. And yes, so this is all about SIP. Disadvantages of SIP: discontinuity, discipline. Like if you are not consistent with your SIPs, then it is of no use. You should be consistent. You should be not like a, um, you have paid for 2 months, then you didn't paid for 3 4 months, then again you started, then again you broke, then again you started. And you should have a patience. The very, the very crucial disadvantages, I would say crucial disadvantage, because because we don't have patience. We don't want to wait for a longer period of time. We just want to, we just want to get a quick gain. We want quick return. We want to be a crorepati within a year. It is not possible. It requires a lot more time, and it is only possible with consistency and discipline. So these are the disadvantages of a person, who is doing SIP. If I talk about SIP disadvantages, I don't think we have any. We can consider some if you want, like market risk. There is a market risk. We don't know that when the market is going to rise or fall. It depends on certain parameters, as I told you, economic parameters, government structure, and etc. etc. Also, we are in the zone of war, wherein we are in the war zone. So we don't know that what happened next. So I think that the market is more riskier because of the ongoing wars. So and there is a more uh, possibility. There is a more possibility of, of the market going into recession. So there is a high chances of going into recession. So at this point of time, uh, I am avoiding to make any investment or to do anything, because we don't know that anytime market risk can come. So yes, this is the market risk which we have to consider. Second, discipline, consistency, and patience. So we have discussed. So yes, these are the disadvantages of SIP. Anything more I can help you? Have you understood the concept of SIP? Okay, the roles of fund manager. Okay, just give me a minute. I'll take out the slide. Roles of fund manager. Okay, so imagine you are a fund manager. Okay, Jasmina, you are a fund manager. I have given you my money to you. Now, what role you will play? You think on that perspective. Okay, I mean what they do. All right. So, if you are a fund manager, what would you do? I have given you my money, my capital to you. So, what would you do? You think of that perspective, and automatically you will get the answer. And but let me tell you also that the roles are, if I am a fund manager, my role will be to do an equity research, to do a research of on a particular security, particular stock, particular asset, and based on my research, I will make the decision that whether I have to buy the stock or whether I have to sell the stock. Okay, so if people are giving me money to invest, I'll first consider that yes, this investment, this asset, this security is good. So I'll buy that security with the help of the money that is given by the investor to me. And my role and what is my crucial role is I want to manage the asset. I want to manage the money of the investor. Okay. Like if they have given me, they have trusted me. I cannot make loss and I will say them that sorry sir, I have made some losses. So I cannot tell them. If someone is giving me, someone is trusting on me, I have definitely have to make profit. So for that, what is my role? I have to do equity research. I have to buy and I have to sell the stocks on the basis of certain parameters. I want to manage the portfolio. Like yes, if I know that yes the recession is going to come, I will diversify my portfolio. I will put my stocks into some into some safe companies, some good large cap companies that will not collapse. I will remove my money from from small cap companies and I will invest it into large cap companies. So this is my role. I want to manage the assets. I want to manage the money of the investor. Okay. Are you getting me? Okay. All right. Good. Anything more which you want the clarity on? No, there is no any charges for fund allocation. But yes, as I told you that if you are exiting, if you are withdrawing your fund within a year, there are some charges which you have to pay. That is exit load charges, expense ratio charges, then brokerage, short-term capital gain. These are the charges, these are the expenses that you have to pay to the fund, to the institution. Look, the thing is, fund manager will not directly charge from you. The company which he is working in, the company will charge from you. Okay, any amount, whether it be exit load, expense ratio, or anything. I have discussed one concept in which you can, which is known as STP, systematic transfer plan, in which you can transfer your from one scheme to another. So that can be done only if you have taken that STP. Okay. So if you have chosen once that yes, I want to invest in this mutual fund, you have to go with that. You cannot, you cannot withdraw and you cannot again put because it's not that easy. right? So you need to pay some additional extra charges for it. Did I answer you to to the question you asked me? Is it fund manager charges any amount for fund allocation? Okay. Okay, yeah, good. Cool, cool. Okay. Now we can have a break of 5 minutes. But if you guys have any question, ping me on the chat. I'll definitely look into it. So we'll meet at 10:56. Okay. where we have left. Okay, so we have done the risk in mutual funds. Just wait a minute. Okay, we have done the mutual fund redemption process, fund manager role. Yes. So we have done till here. Now, moving forward, popular mutual fund categories. So there are many mutual fund categories, but the popular ones are, growth funds, income funds, balance funds, index funds, and so we have all studied and learned this in a previous slide. What are growth funds? What are income funds, balance funds, index funds? Now let's consider one example. So as we know, growth fund invest in stocks with capital appreciation potential. Growth fund is nothing but that we all know that a company, a fund that looks for a company which is growing, which has a higher growth potential. So that are known as a growth fund. So they invest in stocks with with who has a potential to gain to grow a lot in the industry. Okay. So these are some popular ones you can consider for your study purpose, for knowledge purpose. You can go ahead and look after it. You can read about it. You can read the fact sheet. You can know more about these funds. Now let's move ahead. Mutual fund industry overview. Okay. So here we have an example. Indian mutual fund AUM crossed rupees 40 lakh crore in 2024. So you can imagine how much is rupees 40 lakh crore, and that too in a single financial year 2024. Now what does AUM means? AUM means asset under management. So in India, mutual fund has an asset of rupees 40 lakh crore which is under management, under some some fund managers. So definitely this number is going to increase in the coming years because of the craze, and the craze of mutual fund is rising, and more people are investing it. So this number will rise more. So yes, this has a very good future perspective in the coming market in India especially. And yes, I have bought some some tasks, some homeworks for you guys. So, wherein you have to just research about the mutual fund industry. What are its size of industry, number of schemes, and investor base. So these are the three small things that you have to do as a homework, so that you can also get a good grasp of knowledge on mutual fund. So please note it down, and if you want, you can go for it. All right. Okay. Now, mutual fund myths. Okay, what are the myth of mutual fund? You need a lot of money. It is a myth. As I told you, you can even start with rupees 100 SIP. Now you don't tell me that you don't have even 100 rupees in your hand. 100 rupees is like, even a every even a kid also has 100 rupees. Only experts can invest? No, it is not. Mutual fund is a platform designed for the people who is not experienced, who are not experts. So the mutual fund appoint expert and helps the individual to invest their money. SIPs give guaranteed returns. No, it is not always true. SIP now doesn't give you a guaranteed return, so don't consider you know yes, this SIP has given 100% return in the past 1 year. So don't consider it. It depends on the market risk. It depends on the volatility. Okay. So it is not always true. Past return is equal to future performance. Never consider past return as your future performance. Okay. Your past return was something which is there, which was there in your past, and future is what it is coming. You cannot predict future like a past like in the past it was having this much of returns, so in the future it will be like same. No, it is not always possible. Okay, moving ahead. Common mistakes to avoid while investing without a goal. As I told you that you should invest with having some goal in your mind, like how much profit you have to make, how much risk appetite you are you are willing to accept, how much number of years you are going to hold. So you should have a goal before investing. Switching funds too often. Don't switch fund like it is not making a return, so let's switch it. Because to make money it takes time. So even the fund is not performing well, it is not like that it will not perform well in the coming years. It will. So have some patience and don't switch too early. Chasing past performance. So do not chase as we have discussed in previous slide. Do not chase for past performance like it will perform the same in the future as well. No, it is not. Ignoring fund charges. Always look at the charges that fund is having, is charging with you. Okay. So there are some charges that you should consider in mind, or otherwise it will kill your gains. It will eat your all your profits. And lack of portfolio review. Okay. If you have invested in mutual fund, don't don't be like, uh, you should always check your portfolio. Do not consider it on the fund manager. And yes, this was all about some common mistakes to avoid. Next is case study, wealth building with SIPs. Okay, so this is just a case study for knowledge and educational purpose. Do not consider it as any investment advice. This is just a case study for educational purpose. So if you are investing rupees 5,000 per month in Nifty 50 fund, and that too for 20 years. If for 20 years consistently you are investing rupees 5,000 per month, so we can take an average return of 12% because mutual fund gives us around 12%, so we can take it as an average. Okay. So for 20 years you have invested rupees 12 lakhs, and after the end of 20th year you will be having rupees 50 plus lakh in your hand. That is more than 100, 200, 300% return that you all have got. So your 12 lakh is now been made to 50 lakh or more. It can be more, but it cannot be less, I'll tell you. Yes, in certain scenarios, certain cases, it can be more or less, but it is definitely, it will be going to be greater than 12 lakhs. Definitely you will be going to earn 100 or 200% definitely in the 20 years. So this return that no bank, no any security will be giving you. So but the mutual fund will. So if possible, you can even start your SIP as early as possible. Okay. And even you can do your SIP with rupees 10,000 per month. So even it will give you a more return. Even it will give you a more, and your corpus will be built extraordinary. You will have a good gain and good crafts on the investment. So here is a real life case study wherein this is your second homework, that you have discussed a top performing fund, for example HDFC equity fund. You just take out one top performing fund, do a research on it, know its who is its fund manager, how long, how old is that fund, and what are the ratios, expense ratio, then exit load, then some expenses. So you do it by yourself. This is your homework number two. Okay. So this will help you in, in exploring mutual fund, in gaining some knowledge, some expertise, and you will have a good command on it. Okay, guys. So right by this second session about mutual fund. Just a minute. Let me check my internet connection activity. All right. So, so this was all about our today's session. I hope you guys have enjoyed and you have learned a lot many things about it. And we have discussed about mutual funds, types of mutual funds, what are they, how do they work, who are the fund manager, what are the roles of fund manager, advantages, disadvantages, what do they do, SIP, SWP, STP, and many more things we have discussed. ELSS fund, that is tax saving fund. Okay, so now we have done with our bonds and mutual funds. Now we have left only with our one session, that is third session, which is about valuation. That session will be very much interesting because we will dive deep into the bond valuation. We will learn how to value a bond, how to value a perpetual bond, how to value a plain vanilla bond. So yes, stay tuned. That session will be, much more interesting and helpful for your knowledge purpose and your educational purpose. It will also help you in your interview as well. And so this was all about my second session. I hope you guys enjoyed. Thank you for your attention.